Hello everyone, thank you so much for joining. Today I'd like to cover and introduce the cash conversion cycle. We had an earlier session on working capital and it's basically a similar concept. They belong together. As you may recall, net working capital, or more specifically net operating working capital, equals accounts receivables plus inventory minus accounts payable. And while net working capital looks at the amount, whether we have $50, 50,000, 30,000, 300,000 in accounts receivables, inventory, accounts payables, or net operating working capital, when we look at the cash conversion cycle, we are more concerned about the days. How much days it takes to liquidate your inventory, how many days it takes to collect your cash from your customers, and how many days it takes to collect or to pay your suppliers. Yeah, so when we talk about cash conversion cycle, same concept. We are not introducing more items. We are again focusing on accounts receivables, inventory, and accounts payables. But here the main difference is we are not looking at the dollar amounts. We are looking at the time it takes. Yeah, so let's get started. In general, the cash conversion cycle is the average days from the day cash goes in to cash goes out to cash comes in. Yeah, usually you pay your suppliers first, cash goes out, you produce your goods, and then at the end, when you sell your products, money comes in. Yeah, and the difference, that's what we call cash conversion cycle. So if you look at a regular standard production company buys inventory. Yeah, then the company pays for inventory. Then the company sells the product, and then the company receives payment. Yeah, if you put this on a timeline, here again, if you don't sell your products on credit, then those two lines here would be the same. And if you pay your supplier in cash directly and not on credit at the same time, then those two lines would be the same as well. Yeah, so in general, when the company buys inventory on your balance sheet, you would record inventory. Yeah, and you can see you sell the product. So here the product, your inventory is gone because you have sold the product here. So that's why inventory is not here anymore. Once you ship the products to your customers here, you would record accounts receivables. We discussed this earlier. This is the time it takes until you receive payment from your customers. Once you have received payments from your customers, you would basically reduce the accounts receivable item on your balance sheet. And for accounts payables, it goes the same. Yeah, so you buy your inventory first here, but because you pay at a later point to your supplier, you have a liability until you pay. Yeah. So now, very important, if we look at cash conversion cycle, cash goes out, cash goes in, pays, and companies receives payment. So our cash conversion cycle is this one. Yeah, cash conversion cycle, cash cycle. That's the time. And this is quite critical because the longer it takes between you have to pay your supplier until you receive payment from the customer, the longer this gap needs to be financed by the company. Yeah, they need to use other financing means to basically fill the gap they have. And then, just for the sake of completeness, we call this one, the entire line, operating cycle. Yeah, that's the entire time it takes to get started in your production, from buying the inventory to the very last step to receive payments. Yeah, here today we are concerned with the cash conversion cycle. So the cash conversion cycle, if you look here, would be the same as for your net operating working capital. So it would be inventory plus accounts receivables. Then you have the entire timeline minus AP would leave you with cash conversion cycle. However, in this formula above, we are dealing with dollar amounts. Here we are dealing with days. That's why we are concerned not with inventory, we call it inventory days, accounts payable days, and accounts receivable days. Yeah, because everything is lined up on a timeline. Some other words: inventory days, days inventory outstanding, days sales outstanding, days payable outstanding is exactly the same. Yeah. And what we have, if we go to DIO, equals inventory minus cost of goods sold divided by 365. DPO, accounts payable, cost of goods sold 365, and DSO equals accounts receivables divided by revenue 365. Yeah, here very important, inventory belongs to cost of goods sold. Accounts payables, also when you buy inventory, it's your part of your cost item on your income statement. And when you sell products, accounts receivables, days sales outstanding, you don't use cost of goods sold, you use revenue. Just be mindful, on the internet, many wrong formulas. DIO, COGS, DPO, COGS, DSO, revenue. Yeah. In general, when we look at different companies have different profiles. Here, from a pure operational financial perspective, we aim for a small cash conversion cycle. There are industries like airlines, they even have a negative cash conversion cycle, because when you purchase a ticket, you pay it before. Airlines don't have much inventory, and their contracts with their suppliers, like fuel, for example, are very long-term, though they can pay their fuel or maintenance contractors at a very late point of time. So that means your cash conversion cycle can be negative sometimes, which improves your liquidity, increases your operational efficiency, and sometimes means there's a good business model underlying it. Yeah, so just an idea to introduce cash conversion cycle, quite similar to what we discussed with working capital. We will do an example at a later point in time. I will go into more detail and cover the specific items as well, but just to give you some basics. Thank you so much for joining. Talk later.